Bear with me. Let me just, it's very important that I read the disclaimer. Hi, everybody. Welcome to BK Forex. As always, trading foreign exchange on margin carries a high level of risk, may not be suitable for all investors. I ask you to read this disclaimer very carefully and to understand all the risks associated with trading on margin, and to seek financial advice from an independent financial advisor if you have any doubts. Okay, if there's any other questions, feel free to ask me. All right, let's go back to the charts and to our topic of the day today, which is how do stop losses work in FX? And it's a pretty interesting and I think sometimes misunderstood topic in currencies. And I think sort of the first interesting thing to see is this is a daily chart, 10 days. This 10 days is actually pretty good. We can go to 30 days if you want. But what I want to just show you is this is the 37 level. This 3750 level. This is the 38 level, right? This is the 3650 level, 3600, 3550, and the 135, right? And actually, let me just go to 30 days so you can kind of see this a little better. So one of the interesting things you'll see is when you subdivide the charts into these 50-cent levels, is you see how there's so much chunkiness around these key levels, and especially, and I'll get to like the reason why some levels have a lot more. By chunkiness, I mean where prices tend to kind of go up and down, up and down, up and down, and then dance around very, very key numbers, and then come back and find support around a lot of very, very key numbers over here. And the question is, like, why do they act this way? Now, there isn't one single answer to any of this. Obviously, prices act this way for a whole bunch of reasons. There's fundamental data. There is major macroeconomic risk. There is sometimes unexpected news that creates massive imbalances in supply and demand. I mean, ultimately, prices move because of supply and demand, because either there is a lot of supply and nobody wants to be a buyer, so prices are sold, or there's a lot of demand and nobody wants to be a seller and prices are bought. But on the intraday inner workings, what is it that makes prices run towards certain levels and then kind of reverse themselves? Like, I mean, here's a very good example of it, just a run towards the current level and then reverse itself, and then stall at another level that just seems to be, very surprising. I mean, you see these prices going up and down, but then just really stalling for quite a long time, then exploding, then touching, then coming back, then touching, then coming back. And you see this pattern over and over and over again. And I think, part of the reason for why you have these type of patterns is because the forex market is obviously a highly speculative market. It's very, very heavily geared. It's got a high amount of leverage, which means that anybody who trades this market has stop orders. Basically, almost nobody in the forex market, unless you are let's say a corporation or a big pension that has that's just buying a lot of European stocks and really doesn't care about currencies, simply wants to hedge out its currency risk. Or, I don't know, a sovereign wealth fund that's buying a lot of bonds and just, again, also wants to hedge out its currency risk. Those are super, super large players that will basically trade cash on cash, right? So they have $1 billion of stocks they want to buy, so they want to buy $1 billion of currency to offset that. But all the speculative players, the players that are actually trying to profit from up and down movements in price in the market, are certainly always trading on margin. Some of them trading on very, very high level of margin. And of course, the higher level of margin you trade on, the more necessary it becomes for you to have a stop. You can't simply trade like an investor. If you're trading like a trader, you have to have a stop. Otherwise, you simply have a very short lifespan. You'll just, the combination, for example, if you're trading on 20-to-1 leverage and you're wrong by 5%, you've wiped out your whole account. You don't even get a chance to be wrong by 5%. You get a chance to be wrong basically by about 2.5% before the broker sells you out automatically. So the point is, if you're trading on leverage, your margin of error is very, very small. And therefore, you need to protect your capital with stops. Now, as human beings, most of us like round numbers. Most of us simply like sense of order. I never forget this story that happened to me when I was in high school. I had a class in high school that was a class in drama, right, of all things. In high school, back when I went to high school in America, everybody sat in their assigned seats in all the other classes. Like, in other words, the first day you would come in, the teacher would tell you, here's your seat, this is where you would sit, and so on and so forth, right? And so we get into the drama class, and the professor doesn't say anything, doesn't give us any direction, doesn't give us any instruction. So everybody kind of looks around at each other and then just takes a seat, without being assigned a seat. And this goes on for about a week, and then goes on for another week. And then the drama professor says, I want you to take a look at the seat you're sitting in 2 weeks after. This is 2 weeks after the class started. And everybody looks around, and it basically was the exact same seat that we chose voluntarily on the first day that we came into the class. And it was his own little way to show us a sort of a small human experiment in how the human mind, even in a sense of randomness and chaos, always likes to seek order. So my point is that even in markets which are random and chaotic and have a lot of different movement, humans like to impose some sort of order. And they generally like to impose the order around round numbers, because round numbers like 50 level, 100 level are all very, very sort of psychologically attractive to them. So very often, customers will leave orders or their stops around those round numbers. Maybe sometimes they'll be clever and they'll do 03 or 5 or 10. But they basically leave numbers around the round numbers and the half pennies. Now, the other aspect of the currency market that, of course, all of you know, but I think it's very important to understand exactly what that means, is it is not an exchange-based market. It is not a one-to-one market. Excuse me, it's not a one-to-many market. It's a one-to-one market. When you're actually making a trade, you're not making a trade into a blind pool exchange where lots and lots of other people get a chance to buy your trade or sell your trade. You're making that trade with your broker. Now, even if your broker is what's called an STP broker or an ECN broker or a non-dealing desk broker, so your broker on the retail side is acting as a facilitator in that case. So in that case, he simply takes your trade and then he throws it out to his broker, right, which is the interbank market. And the interbank market then takes your trade. But the point is that somewhere along the line, the broker really knows where most of the stops are. Now, in a case where you have a situation where your broker is not is a non-dealing desk broker, the interbank probably doesn't know your exact stop, because your exact stop is sitting on your retail platform, not on the wholesale platform. But they can guess it. They can pretty much know exactly where most of the stops are. But in fact, they really, frankly, they're not even thinking about. Certainly, they're not thinking. They may think about you as an aggregate. They may say, there's a lot of retail order flow, so that means they probably put their stops with the OOs. And this is where it gets interesting, because what happens is, let's understand, the kind of situation that happens. Here you have, and I'm just going to pick a random data point on the euro just to explain my point. So here you have the euro falling like a stone into the 35 area, right? And a lot of retail accounts and a lot of speculative accounts may say, "Oh, this is a momentum trade. Let's short the 35. That means there's a lot of selling going on. It's probably going to crack. It's a big support level. It's going to crack, right?" So what happens is there's a lot of buyers now at 35, right? Generally, what happens is when you're a seller, the interbank market is the buyer. The interbank market's function is to make liquidity. So if you're selling over here, the interbank is going to be on the opposite side. So hour goes by, 2 hours goes, 3 hours goes by, and it kind of consolidates around this level. It's really not moving. And so that suggests that maybe there's just not enough selling pressure to move the euro down. And then the euro starts to move itself back up very slowly. So everybody who sold over here is starting to get panicky. And generally what they do is they'll leave a stop maybe 50 points back if they're day trading. If they're swing trading, maybe they'll leave a stop 100 points back. But the point is, once he gets up to like around, let's say, I don't know, a 35 or 40, right? And remember that you in individual form really doesn't matter. But if the broker says, "Ooh, I sold we bought about, I don't know, $500 million worth of euros at around this level, and now the euro is like around 35." That means a lot of people probably have stops at around 35.50. So what I'm going to do now, is I'm going to go into the interbank market. I'm going to spend, because the other thing you need to understand is, if I sell to you, right, and you're holding a trade and you haven't sold it or closed it out, the trade is open. It's floating. Now, there's two possibilities. One, you could be dead wrong and you'll just get margined out eventually somewhere over here, which happens quite a lot, right? Or two, you may actually be right. And let's say, I don't know, currency markets turn, let's just say there's another scenario, and currency markets really do turn down and it starts to go back down below 35 and goes to 34.50, and you eventually close yourself out at a profit, right? Well, the interbank dealer understands this. The interbank dealer basically understands that, first of all, his profit is your loss. And this is just the reality of life. It's not anything nefarious. This is a speculative market. The speculative markets, somebody's going to win, somebody's going to lose. So you need to understand, it's like that old statement. If you're sitting at a poker game and you don't know who the patsy is, then you're the patsy. So you need to understand very, very carefully how the actual dynamics work. So the broker's win is your loss, but it only becomes a profit if you book a loss. In other words, until you're floating, like I said, there's only two potential scenarios. One, you get margined out, or you may get lucky and it may turn itself around. Now, the broker understands it. So the broker says, "Oh, I'm within, let's say, 5-10 points of a potential stop loss area." And so what I want to do, and I'm sitting on $500 million worth of 500 million euros worth of long orders that I filled over here. So I'm going to spend 50, maybe 60 million euros, whatever it takes. Maybe it only takes me 20 million euros, whatever it takes. I'm going to try to push prices up to move prices towards the 50 level. What's going to happen is that everybody who's got stopped over there is going to naturally get stopped out. So now those floating orders become losing orders. Losing orders to the customer, winning orders to the broker on the other end of the transaction. And now he has booked his trade. Now he has booked his actual P&L. Not market to market, but, in actual trading. And remember, while I'm just explaining to you how this works from a retail perspective, what's actually happening in the interbank market is that the broker is actually doing this against corporate accounts, customer accounts, hedge fund accounts, everybody else for whom he's making markets. So he's not really looking at you individually. He's looking at whatever he's got on his own books, plus whatever he suspects there is in the marketplace, and trying to move prices. So very, surprise, surprise, boom, prices go up here, right? And then if there is no real reason, or maybe there's a fresh reason to want to sell, prices will very, very quickly dip down. And then here again, we have the same process. Everybody sells down, but no, there's no more further follow through, and boom, we get tagged out, right? Now, brokers are by no means, or dealers by no means always right. Dealers generally right when they have these kind of wonderful range-based markets where they can sort of sell the highs, buy the lows, sell the highs, buy the lows. And in this kind of situation, it's certainly very, very lucrative to want to mimic the dealer. So you want to basically be buying the sells and selling the rallies, right? But if that was that easy, everybody would just mimic the dealer and nobody would ever lose money. The thing about currency markets is that when the tide turns, it turns with a viciousness. So occasionally the dealers will make, will put liquidity out here, make liquidity, let's say to 136, and they'll get bowled over because there'll be so much positive news, or there'll be so much demand that there is no retrace. There's no way to take the money back. And sometimes they themselves have to cover up around the 50, and that actually creates even more push all the way to 3,700. Now, this is where it gets really, really interesting. Look at this. This is a 1 hour chart. Look at this area between 3,700 and almost 3,800, right? All the way up to, again, where does the euro die out? It dies out at right around the 38 level in round numbers. But look at this massive move. Where does this massive move come from? This massive move comes from a very, very interesting point, because not only are stops put at round numbers, they're also put at major highs and lows. And let me go through what are the major highs and lows. They really go in the order of importance, from least important to most important. When I was in the dealing room, when I would come visit the dealing room, I would always see in the dealing room on the board written down all the highs and lows in various currencies right in front for the dealers to see. So from the least important being that the highs and lows are done daily, right? The daily highs and lows are important stop levels, and you'll see how daily highs and lows get certainly run. Like, for example, right now, we're putzing around. The daily high, the daily low on the euro is 73. And we're really putzing around. They really want to see if they can try to tap it here. And they may very well try to tap it here before the end of the day, because they know there's some stop orders over here they can trigger by tapping the 73s to the downside. The second most important is the weekly, highs and lows. The third most important is the monthly. But the really important highs and lows are the annual, the yearly highs and lows. And this is where this particular movement becomes so interesting. So this is about a 4-hour development that moves about close to 150 points in the euro. Very, very big, powerful move. Why? Well, let's take a look at the daily charts for the past year, right? And actually, yeah. So you can actually see that I have my. Let me just make this medium thickness. This is the yearly high. Look, the moment it breaks the yearly high, look at all of the massive stop orders that it triggers. But not only does it trigger stop orders at those levels, this is where you get the momentum move. Everybody who was short now has to cover. And then, of course, the guys who are pressing, the momentum traders, are pressing the move to go higher and higher and higher. And that's why when the highs get taken out, the yearly highs get taken out, you have typically a very, very strong breakout move. But notice how just before the highs get taken out, you get tested. These are daily charts, and we got tested back until we finally broke it higher. Now, what does it mean to break definitively? That's really more of a question of art than science. But generally, I would say if it's 25 points above the particular high and low, that's a pretty good sign that all the stops have been cleared, that all of the weak buyers have been taken out, or weak sellers have been taken out, and at that point, it's ripe for a breakout. In other words, if it's 1 or 2 or 3 or 4, that's just people testing stops, right? Just running stops and coming back. But if we're 25 or 30 points above in the euro dollar, that's a pretty good level to consider that this is a genuine breakout, and you want to maybe join the move instead of try to fade the move. What happens very frequently with retail traders is they say, "Oh, it's the yearly highs, and look, it's above yearly highs. I'm going to sell." And they become fodder. They become basically complete and total fodder for these big momentum moves, because these momentum moves are exactly what the big momentum funds seek. They just want to pulverize anybody who's in their way, and they usually start covering right around here. What do they basically say? I'm gonna get short 37.30 and cover 3,800, and of course that's exactly where they get stopped out on the move. So that's the basic dynamic of how stops work in the currency market. You have to understand that first and foremost, every single day, dealers are going to want to know where do they think the most vulnerable points are. Can they exploit those points? Most of the time, they are very successful at exploiting those points. Sometimes when the news goes against them, or sometimes when demand is a one-way ticket, they get exploited. And that's when you get massive big rallies like this. Like basically when you get big rallies like this, This is dealers getting exploited and getting out of the way. They're not providing you very much liquidity, so if you want to buy, you have to pay up all the way up because nobody wants to make markets here because they're afraid that the price is going to go higher. And that's sort of the story of how stops work in the currency market and how trends, in fact, are made. Trends are basically dealers getting out of the way, not providing liquidity, and allowing prices to just go vertical as they feel the demand just outstrips supply, and then just waiting to come back and sell it at different levels to see if they can push the prices back down to even out their books. So I'm happy to answer any questions on this particular subject, and any questions on anything else. And then I want to spend a couple more minutes telling you a couple of other things that I think you'll find very, very interesting. Ben, thank you for the compliment. Boyke is, again, I really want to, Boyke, I want you to understand that, or, everybody to understand this. It's not personal, it's business. If you don't understand that this is a game where people are speculative markets are a game of competition. In a game of competition, people are going to exploit points of vulnerability. It is not a question of being nice. It's not a question of being fair. What's fair is, fair dealing, normal prices, but there's nothing unfair about you being on the wrong side of the market. If you're on the wrong side of the market, you put your stops there, they're going to be vulnerable to you getting taken out. That's just part of the game. Part of this, a very, very important part of this game is to understand that it's important to lose, that you're going to lose, and that there's nothing nefarious about you losing. Because if you only won all the time, then you would, there would be no market. Nobody would be willing to make markets with you. Somebody has asked a very good question. Kundan has asked a question about option expiry. So, Kundan, thank you for asking that question. Let's take a look at, let me just get rid of all these lines. Let's take a look at the chart. I'm trying to figure out what would be let's just see maybe a 15-minute interval, 10 days. Just trying to find, this has not been the best of trading, but let's just, let me just give you some ideas. So, somebody said option expiry. The most important option expiry, and option expiry is basically at what time of the day do options expire? And options obviously have targets. They say, I want to, my euro option has a strike price of, 135, and it expires 10 o'clock New York time, which is when almost all important option expiries expire. And so if the euro doesn't reach that price, I win, you lose. If the euro reaches that price, you win, I lose. So there's always a lot of jockeying before 10 o'clock. And then after 10 o'clock, you have just these big moves very frequently. Now, there's not a lot of evidence of it here because we've obviously had a lot of very quiet markets. And I'm just trying to look at the 15-minute chart here and see if I can show you. One of the interesting things you'll see is that you'll see these big runs right before. Let me just find you a 10 o'clock time frame. Right before or right after the 10 o'clock frame. So here's a 36.50, right? So you'll see prices dip right below, maybe just dipping right below or right above the 36.50 where they got protected right below 10 o'clock, and then boom, suddenly it's like a ball underwater. It lets itself go. Same kind of a thing. Sorry, let me go the other way. I know what this was. Sorry. This is actually a perfect example. It's a great example. So, here's an interesting point. So this is non-farm payrolls, right? Non-farm payrolls, huge. there's a lot of questions here, guys. I'm just gonna let me just finish this thought, and then I'll come back to all your questions. So, non-farm payrolls, huge event risk, right? Moves the euro, but this is interesting. The non-farm payrolls is 8:30 in the morning, right? But notice what happens before 10 o'clock. They really keep a lid on the 3750 level before 10 o'clock, right? Then as 10 o'clock happens, boom! They let as it 10 o'clock passes, the 3750 all of a sudden, let's go, and they let the pair run all the way out almost to 38. So why does that happen? Why do they allow the 3750 to go after 10 o'clock? Because somebody, and I'm just guessing. This is obviously I don't have definitive answers, but this is just simply to show you how stops work with option expiry. Somebody had a huge option expiry at 3750. They didn't want prices to get down to 3750 by 10 o'clock, because if they didn't get down by 10 o'clock, it doesn't matter what happens after 10. As long as it doesn't hit before 10, these people made money on their option. As soon as 10 o'clock struck, they said, screw it. We're not holding the market back. And boom, all of a sudden you see the market rally, which is why this is very, very interesting. After 10 o'clock, non-farm payrolls, you will very, very often see a lot of these big moves up or down through these key levels because of option expiry. So thank you for pointing that out. I'm glad I was able to show you a good example of how option expiry and stops tend to kind of work together. Somebody's asking me about my opinion on gold. I have no opinion on gold. I mean, will gold rally if the Fed remains relatively accommodative? Unless they are super accommodative, unless they add something to their statement saying where we don't see we see interest rates staying low for the foreseeable period of time, perhaps through the first half of 2014. If they add something like that, yes. If they don't, then I don't see much of a movement for gold. There's a lot of talk here about the fact that stops making zeros. I hate to tell you, all of you, but if you're trading futures, if you're trading options, if you're trading FX spot, if you're trading, period, if you're just trading, you are in a zero-sum game. If you're investing for the next 30 years by buying $1,000 worth of indices every single month, and you don't care about prices, and you're looking at capital appreciation and the general bet on the growth of GDP, that's a completely different game you're playing. But if you're trading, you're in a zero-sum game, my friends. Absolutely. Okay, well, time is running out, and I want to just, if you would be so kind, I just want to show you something. Let me see if I can actually bring this over here. Okay, and I will send this URL to everybody. So you can click on this. If you want to understand how news moves, how markets move on news, what are the key fundamentals that really move the market? What are for example, the top 10 absolutely necessary things you need to know in every single currency that could have massive impact of movement on the market? More importantly, how you could try to predict some of this data with much better, more intelligent way of precision than just simply following Wall Street estimates. We will be happy to share our tricks. Why am I not smiling in the pic? I don't know. You're right. I was a little too serious. You know why? Because I hate the way I smile. So, it's probably, I do look like I belong to the Russian mafia in this pic. So, either listen to me or I will kill you. No, I'm just kidding you. But Kathy definitely is the much more photogenic of the two of us. But if you're interested in learning a lot about fundamentals, and more importantly, this is what's very, very cool. Not only am I going to teach you for full 8 weeks our fundamental course, which I really would love to have some of you join us, because I think it would completely and totally enhance your knowledge of the currency markets. But This is the very cool part. After the course, for 1 full month, I am going to trade live our own money, real live trading for 1 full month, putting into practice one of the primary strategies for news trading that we trade in the BK service. And all of that is included in one price. The price is actually very cheap because this is a early bird price, and it's only $475. It's usually $575, but this is an early bird price, all $475. Every single one of these courses will be recorded. So if you buy it, you'll have on-demand recall for every one of these courses for as long as you want it, and it'll be online. So I hope you guys consider this seriously. I'd love for you guys to sign up for early bird because you'll obviously be able to save a lot of money. And as I said, it's both education and live trading. So you'll get a chance not only to learn the basic fundamentals of how to trade fundamentals, but an actual real-life strategy that I use all the time, literally every single week, trading news. The time of the course is going to be between November 12th to December 10th. It's going to be 1-hour sessions, 2 sessions every week, so there'll be 4 weeks. There's a little bit of you'll see the schedule, the little bit of a break. Here's the full schedule. You'll see everything that we teach you over here. And the full schedule is over here, starting from the 12th November to December 10th. We're going to take a little bit of a break for Thanksgiving holiday. And then after that, after all of this November and December education, we're going to, in January, when the markets come back and we're ready to rock and roll, we're going to trade live with all of this stuff. So I think it's a very, very cool proposition because it's both education and live trading that we're going to do. I hope you guys will join us. So the email address to reach us is, and I'm just going to put it over here. contact@bkforex.com. So I am just going through 2 screens. So there you go. So this is our email address. This is the website. The URL is in your link. Just simply click on this thing. Hit the submit now, sign up here, and you'll get the full $100 off $475 for the course. And as I said, everything recorded, everything on demand, so you can watch it as many times as you want. Everything about how to trade the euro, how to trade the pound, how to trade the yen, how to trade the Aussie, how to trade the Canadian dollar, how to trade the Kiwi dollar, and all of our key news strategy. So I hope I'll see you guys in our webinar. I hope you get a chance to really learn in detail all the key fundamentals you need to learn. And I will see you guys at FX Street next week. Right? Next month for another webinar. Right? Hope you guys enjoyed it. I thank you so much. Thanks, guys. So have a great day, and I'm sure that we'll post the webinar. One last thing. Those of you who do not follow me. You should follow me. I'm sure most of you do follow me, but it's let me see if I can just. My handle is here. I'll put this in here. Sorry. At FX Flow. If you want to follow me on Twitter, that's the best way to get a hold of me. I'm there all the time. Tweet at me. I'm happy to respond. So I'll follow you there. Thank you again. And this webinar will probably be recorded and posted, so I'll post it tomorrow for you guys to review. Thank you. Thanks so much, and I'll see you guys. Next month.